Welcome everybody to the next video of this FX program. Now, we're going to jump straight into what imbalances are and recovery zones, or order blocks, whatever you want to call them. A lot of people call them different things. I call them recovery zones, but they're essentially order blocks. And I'm going to talk about what they are and how significant they are in your analysis and how you can use them. You don't have to purely use just these tools, but they are very significant and you need to be able to understand them. So let's get into it. Alrighty, so what are imbalances? And an imbalances refers to the state of uneven distribution. And what I mean by that is when there is an uneven amount of either buyers or sellers at any given time. So if there's far more buyers than there are sellers, that is an uneven distribution and it will leave a gap. And I'm going to show you examples of this on the chart. But that is essentially an imbalance. And that imbalance needs to be filled before, it has to be filled legally because of market equilibrium. That is a law in the foreign exchange market that it must be filled at some point. Now, there is no time frame on when this imbalance should be filled. It doesn't have to be filled tomorrow. It doesn't have to be filled immediately. It can be filled over time. So that sort of sums up what imbalances are. And we're going to dive into what recovery zones are, but we're going to dive into imbalances and recovery zones on the chart later. So a recovery zone or an order block is an area where institutions intentionally influence price to attract buyers or sellers, creating the liquidity required. That, just make sure you pay attention to those words, creating the liquidity required for them to place a much larger position in the opposite direction. And I'm going to talk about this as well, but they are targeting your stop loss specifically. A lot of people, they talk about liquidity sweeps, and we're going to talk about liquidity in the next video, but they talk about liquidity sweeps and institutions are hunting your stop loss. I'm telling you for a fact, as someone who's worked professionally in finance and know many people that have worked professionally in finance for major hedge funds and institutions like UBS, they don't hunt your stop loss. Your stop loss being taken is just a byproduct of their position. And in this scenario where institutions are intentionally influencing price to attract buyers or sellers, creating the liquidity required for them to place a much larger position in the opposite direction. Essentially, they picture this. A major institution, they want to take a large short position and they don't have enough volume in the market to be able to cover that position because there has to be a counterparty to that trade. And if there isn't enough volume, then they can't take the position. So they will actually entice people to think that it's going one way. So they'll entice buyers into the market to make it think that, okay, we're breaking structure now and we're going to continue going higher. People are starting to buy, retail traders start coming in. That creates enough volume for them to actually take that short position in the opposite direction. So I hope that makes sense, but essentially is they just need enough volume to cover that position that they initially intended to take. And that is the factual definition. And that's actually how it works. All these retail traders, all these gurus on the internet talk about liquidity hunting and liquidity sweeps and all this rubbish. And it's not, institutions aren't hunting your stop loss. End of story. So let's move on. Alrighty, so let's talk about their significance. We talked about market equilibrium as a state in economics where supply of goods and services matches the demand, so equal number of buyers and sellers, what we talked about, resulting in stable and fairly valued price. In this condition, neither buyers nor sellers have a significant advantage, and this is essential for efficient resource allocation, stability in prices, fair incentives for buyers and sellers, and avoidance of surpluses and shortages and overall balance. So that sums up the significance of market equilibrium and how important that is, but also how important imbalances are and being able to identify it, understanding the significance of market equilibrium. And now that you understand that, when you do start to see imbalances and just say you've identified a recovery zone or you've identified a major structural low or key level, whatever it is that you're using to actually look at entering a position, because you mark that out on the chart, you're looking at potential areas where price will react. If an imbalance lines up, that's perfect. And the thing is, we're actually going to talk about how that sort of plays into order blocks or recovery zones, because they're very similar, but just not quite the same. But it still leaves an imbalance. It's essentially a little enticement before creating a large move to the upside or the downside, leaving an imbalance. So very similar. But we're going to show you that on the chart. So when price is manipulated and liquidity is taken, institutions are in drawdown, which means that a recovery zone where they cover their footprint is a perfect place for retail traders to set their positions. You don't have to use that. I personally don't use them as much anymore because I've switched to managing a long-term portfolio. But when I am scalping, I'll occasionally look at them. But the thing is, as a trader, I think it's good to be able to understand all aspects and tools of trading. So supply and demand zones, structural levels, key levels, imbalances, recovery zones, all of that sort of stuff, because you're able to, and obviously market structure is king, on top of fundamental analysis. And you're just identifying what's actually holding significance, what's being respected, and you're actually basing your bias based off that. Not, I think a lot of traders, they get caught in their strategy and they're like, only this can work, and I can only take a position if a recovery zone gets filled, not a structural level. But you can clearly see that you just say you have a bearish bias, you're looking for shorts, and you see a clear, the price actions retraced within a bearish immediate viewpoint. We talked about that in previous videos, and it hasn't broken structure to the upside. It's filled a recovery zone, a significant key level, and then broken structure. You can see that it's following bearish market structure. Why not take a position? So that's my thoughts anyway, but let's move on. So we're going to jump onto the charts now. I'm going to show you examples of both. So I'm going to show you imbalances first, but I'm also going to show you imbalances and recovery zones in line with a multi-time frame analysis. We haven't quite gotten to that point yet, but you're going to slowly understand what it means to do a multi-time frame analysis and what actually takes place when you're stepping your way down the lower time frames and getting that overall picture and understanding. So then when you do come to the multi-time frame analysis video, it's going to be a lot easier, and the information and the teaching is going to sink in a lot easier. So look, we're on the weekly time frame on GBP USD, and we can see this point right at the top here before price moves to the downside. And as you can see, price action's mostly filled in this area. It's a bit of a consolidation period, right? Where obviously sellers are more significant, but there's still a bit of tug of war. There's not so much volume here, and then we finally pick up more volume as price pushes down. But I'm going to talk about imbalances here. So we can see all of these little wicks. This is all filled price action here, but we can see this bearish candle here and then a bullish move to the upside. Can anybody actually identify the imbalance here? Because remember, it creates a gap. So where the imbalance actually is right here, from this wick to this wick. And pretend none of these candles are here, and we've got this gap where either the wick hasn't filled it or the wick on the other candle, so the candle before the gap and the candle after the gap, has not filled this area. Whereas all of here, this is all filled. There's no gaps here. As you can see, 0 gaps. This was an imbalance here as well, which I'll mark out, because there is a gap. The wick on this side and the wick on this side has not filled this area. But then, as you can see, price did come down and fill this gap. So this is filled. This imbalance is now filled because we've got candles on the other side closing beneath that level and filling that gap. Here, we can also see now after this candle, or essentially as soon as price touched here, that it has been filled. That is a filled imbalance. Again, the same here. I'm actually going to draw a horizontal ray. This is an imbalance from here to here. That small part, right? This part has been filled, but this is the actual imbalance. It doesn't matter how big or small they are. It's still an imbalance either way. And if we scroll all the way back, I reset my chart, that imbalance still has been filled to this day because price action has not come into this area to fill it. So what we would need to see is price continue to step up and actually hit the above line and fill that gap. So that's essentially what imbalances are. I want you to go away and practice this on the charts for those that are completely new to imbalances, and identify these points. As you can see, all here, there's no imbalances. This was one from this wick to this wick, but it got filled. All of this is filled, 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 filled. This was an imbalance as well. And this is what I was talking about earlier. So we've got bearish market structure, right? Prices stepping our way down. We've had price come up. It's respected this high. Look at this. This is perfect. Great example of what I was talking about before. We've got this significant key level, huge move. Prices come up, retrace it, and it's respected this key level. It has not broken structure to the upside. It's filled this key level, not once, but twice, then broken structure to the downside. We can start looking for shorts. And we can see that price left this nice big move after this bit of consolidation. We're looking to take a short position around this area. Price then retraces, fills this imbalance, and respects it nicely. So we can actually just draw a little box here if we want to. And if you were to take a short position there, put your stop loss above the high and target the low, that would have been an absolutely awesome trade. So almost an 8-to-1 trade right there. Now, I would not take this trade purely based off an imbalance and a key level, but I'm just showing you how, if it lines up with your strategy, it's just an additional confluence to take that position. And you can see it works quite well. Not all the time, but it's still very important to understand what imbalances are. So let's talk about recovery zones, but obviously I want you to go away and practice imbalances. You can either pause the video now and go away and practice before we move on to recovery zones, or you can just do all of it at the end of the video. It's completely up to you. So let's talk about recovery zones. Recovery zones is essentially the last selling candle, so bearish candle, before a large bullish move to the upside, creating an imbalance. And it's the exact same as the opposite direction. So the last bullish candle or candles to the upside before creating a large move to the downside, which creates an imbalance. So on the weekly here, we're identifying weekly recovery zones. So just say we're looking in this range. This is a recovery zone right here. And yes, it's just one bearish candle before a move to the upside. But remember, this is the weekly time frame. You scale that down to the lower time frames. This here is significant structure. And as we can see, price came pushed higher. This is the imbalance. From here, it would have been to here at the time, or here. Then price came down and filled it perfectly before pushing to the upside. It's an awesome example. We'll showcase another one again. Let's look. Okay. It's actually, this is all mostly filled, which is great. So there's nothing here. So this wouldn't be a recovery zone. And the reason because of that is because there's no imbalance that it's created. This has been filled, as you can see here. So that is not a recovery zone. And if you guys want to take screenshots or videos and actually post it in the Discord and ask questions, and you want me to analyze it, see if it's correct, feel free to do that. That's perfectly fine. I'm more than happy for you to do that. But let's scale down to the daily time frame and actually look within the daily. So this here would be a recovery zone because it's created imbalance, this large move. It's the last selling candle, and price right now has filled it quite nicely. And we've had a small little rejection. This is the 4-hour time frame where price has reacted off of that. But we're not too sure if you're taking positions just off the daily, you could take your buy position there, but I wouldn't be executing straight off that. So that is another recovery zone. Now, if we go down to the 4-hour time frame, well, let's look at some here. So this is a recovery zone just here. As you can see, filled quite nicely because we broke structure to the downside. So we broke minor structure to the downside. We had a little retracement, broke structure again. So lower low, lower high, lower low. We're looking for price to retrace within this range, as you can see here on the hourly time frame, fill this recovery zone, which is also in line with a significant key level. This is a key level here as well, as much as a recovery zone or order block, which holds even more significance because it's following market structure. It's not only respecting the recovery zone, it's also respecting the key level, which adds just more significance to that position if you were to take a trade there. And that's how you're stacking. That's how you start to stack your confluences when you start from the higher picture, work your way down, and you just add confluences, also potential risks as well. But that is a perfect recovery zone. As you can see, respected that quite nicely before pushing to the downside and breaking structure. So that is a recovery zone there. This here would not be a recovery zone. And the reason for that is because it's been filled. There's no significant imbalance there that is created after this candle here, because that's been filled. This here would be a small recovery zone as well. Has not been filled yet. But I'm not going to go ahead and fill every single recovery zone possible. I want to be marking the recovery zones that hold significance. So if I'm in bearish market structure, I would want to mark, just say, I'm going to actually start new. Let's go to here, right? Just say we're looking at this current price action. We've gotten our bias. We've seen 2 breaks of structures to the downside. I want to start looking for a short position. Now, this here is pretty much a recovery zone right there. That's a very small recovery zone. But we want to take a short position somewhere in this range. So I would start on the 4-hour. Actually, I wouldn't really do this because this is more of a 1-hour. So this is the 4-hour range, and I think 1 hour actually. But we've identified a significant structural level and recovery zone right at the top. But I also want to mark out any recovery zones that are within this range that we could potentially take a position from. So let's actually look. There's nothing really here. 15-minute maybe. Okay. So there is one here. And I would actually just extend this to the high because a lot of this is just consolidation before that imbalance where that recovery zone is. And this is a key level. So I want to be wary of that whole area. This is also a recovery zone, which is very close to being filled. Pretty much, you could pretty much say that's been filled. This is also a recovery zone. Now, I wouldn't really worry about all of these ones down here because I don't want to be selling right at the bottom of a range. So pretty much from halfway above. But if you want to mark all of them at the start and just monitor price action as you go, you can absolutely do that. So let's press play and see how it goes. All right, so on the hourly time frame, we came up. This was actually looking quite promising. We had a few rejections and a push to the downside here, but we're not quite there yet. Pretty ugly price action. Price is pushed up. We've come into this significant key level right at the top here. So what we can do now is get rid of this, and get rid of this, because clearly it's broken through. It hasn't held significance. This is starting to look a lot more promising now. We had price create a lower high here, lower low, now a lower high. So price action is looking pretty messy. I'm going to be completely honest. Scaling back to the hourly time frame, you can see that price action had filled this recovery zone quite nicely, respected it again, and continued in that bearish market structure. And the goal is, in that scenario, to scale down to the lower time frames and look for potential entry opportunities to enter a position. This here, you might have taken a loss here after this price action here had swept that high, but then we saw another broker structure confirming that bias. That's when you can start looking for a position. This area here looks pretty good to me. That's where I'd be looking to execute and ride that wave to that structural low. So I hope that all makes sense, guys. I hope that covers recovery zones and imbalances quite well. If you need to rewatch this video, ask questions in the comment section below, and obviously be sure to join the free Discord community. That'll be in the description below, and you can ask questions there, send screenshots, send screen recordings, and we can go through it together if you have any more questions. So I hope this video provided some value for you guys, and you beginners are starting to learn this multi-time frame analysis and how you can actually start to gain a bias, look for risks, look for opportunities, stack your confluences, and really actually start trading methodically and with impact and effectively. So thank you all for watching, and I will see you on the next video. Thanks, guys.